So welcome back. Our today's lesson is the financial statement of a sole trader. A sole trader is that individual who carries out the business alone. So it's a business conducted by one person. So introduction, a sole trader is also known as a sole proprietorship, is a type of business entity which is owned and run by an individual, and where there is no legal distinction between the owner and the business. As a sole trader, your business is owned entirely by you, grown by you, and ultimately succeeds or fails by you. So this also means that you are entitled to all profit the business, all profit that the business makes. So becoming a sole trader is simple. All you need or all you have to do is register your business name, and you can start trading. There's a huge incentive of becoming a sole trader. With them come terrifying or, depending on your personality, gratifying side effects. Financial statement of a sole trader involve the following. So as a sole trader, you are required to prepare the income statement. As a sole trader, you're also supposed to prepare the statement of financial position. The statement of financial position is the one that we also refer to as the balance sheet. So the top balance provides the essential input for the preparation of these accounts or statements. These accounts statements provide necessary information to various interested groups, e.g., shareholders, investors, creditors, employees, management, and government agencies. Remember, when we were discussing the users of financial statement, these are the interested parties or the users of the financial statement. So that is the shareholders, investors, creditors, employees, government, agencies, management. All those are the interested parties or those people who use the financial statement. So there are these financial statements. These financial statements are prepared to serve the information needs of these diverse groups to enable them to make appropriate decisions. So the income statement, at the end of the year, every business must ascertain its net profit or loss, and this is done in two stages. It is done in two stages. One is find out the gross profit or gross loss, finding out the net profit or loss. So how do we determine the gross profit? Remember, the gross profit, we take the sales or the sales revenue, we less the cost of sales. Cost of sales is made up of opening stock. We add purchases. We add carriage inwards. We less return outwards. We less closing stock. And that is how we get the total cost of sales. So determination of gross profit or gross loss. So gross profit is the difference between the sales proceeds of a particular period and the cost of goods actually sold. Since the gross profit means the overall profit, no deduction of any sort, i.e., the general administrative or selling and distribution expenses is made. So gross profit is said to be made when the sale proceeds exceed the cost of goods sold. On the contrary, if the cost price of the goods is more than the selling price, then we can say that there is a loss. So the entries stroke items that will appear in the income statement to ascertain the gross profit or loss will be items to be debited. So we have the opening stock. It refers to the value of goods at hand at the end of the previous accounting year. Opening stock means the stock of an item at the beginning of a new inventory keeping period. It becomes the opening stock for the current accounting year, and it contains the value of goods which the business deals. So the closing stock of yesterday is usually the opening stock of today. So what you closed with yesterday will be the opening stock of today. So the other item is purchases. So it refers to the value of goods in which the concern deals, which are purchased either on cash or on credit. For the purposes of resale. So the balance of the purchases account appearing in the trial balance reflects the total purchases made during the accounting period. While dealing with the purchases, we must bear in mind the following aspects. A. Purchases of capital assets should not be added with the purchases. So the purchases of capital assets should not be added with the purchases. So this simply means that if you deal with the selling of stock, like maybe you have a kiosk, and what you sell is the normal stock, uga, sugar, coffee. That is you sell tea, coffee, you sell sugar, you sell uga, you sell all sort of stock. When you buy motor vehicle, you cannot include it on purchases. You cannot include, since a purchase of motor vehicle is not one of the items that you deal in as stock. So stock is what you buy and sell. Stock is what you buy and sell, or simply what we call purchases is those items that you buy for resale. But when you buy a fixed asset is not bought for sale, it is bought for use. So you use it in the business to facilitate you generate more sales. And therefore, when you purchase a fixed asset, it should be treated as a fixed asset and not purchases or stock. So if it is already included in the purchases, it should be deducted immediately. B, if goods are purchased for personal consumption and are added with the purchases, they should be excluded. These types of purchases should be treated as drawings. C, if some of the goods purchased are still in transit at the year end, it is better to debit stock in transit account and credit the cash or suppliers account. Remember, when goods have already left the supplier and they are yet to reach our business, yet to be received by the intended buyer, those goods are treated as goods in transit because they are on the way. They are not yet received, but they have already left the premises of the seller. So if the amount of purchases include goods received on consignment, on approval, or on hire purchase, these should be excluded from purchases. They should be excluded as purchases. So the cost of goods sent on consignment must be deducted from the purchases in case of a trading concern. Then we have number 3, the purchases return or return outwards. So sometimes a business will purchase goods and maybe due to some reasons, maybe the goods are not of the intended quality, intended quantity, or maybe they are not the right goods that were ordered. They are returned back to the seller. So that is what we call return outwards. Then when we sell goods to our customers and then the customer did not accept the goods and return them back, they are treated as return inwards. Return inwards are added to purchases because they are increasing our stock. So it may come about that due to some reason, the goods are sent back to the supplier. In that case, the supplier is debited in the book of accounts and the purchases, returns outwards are credited. It appears on the credit side in the trial balance, and there are 2 ways of showing the purchases returns in the income statement. It may be shown by way of deducting from purchases in the income. So statement in the income statement. An alternative way is to show the purchases returns in the credit side of the income statement. So both ways are accepted. Ways are accepted. So either you show the purchases return. So when you purchase goods and then you return, we deduct from purchases. When goods are sold and then they are returned back, they should be deducted from sales. So the other item is number 4, direct expenses. So these types of expenses are incurred in connection with the purchases, procurement, or production of goods. These expenses are directly related to the process of production. It also includes expenses that bring the goods up to the point of sale. In simple terms, that is what we call the carriage inwards. The cost you incur to bring goods to your business premises when you purchase. It is added to purchases. So items to be credited. So the items to be credited, we have sales. So remember, we used to open the trading account. When we had the trading account, we had a debit side and the credit side of the P&L account, or the trading profit and loss account. So on the credit side, that is where we record sales and also the sales return. So sales refers to the sale of goods in which the business deals, and includes both cash and credit sales. It does not include sale of old, obsolete, or depreciated assets which were acquired for utilization in business. However, goods sent to customers on approval basis, free samples, and sales tax, if any, included in the sales figure should be excluded. So what we are saying is that sometimes the business will sell a fixed asset. So we don't combine the sales of fixed asset together with the sales of stock, because in the income statement, what we need to account as sales is the sales of normal or ordinary stock of the business. But when you sell an asset like furniture, computer, or motor vehicle, only what we recognize is the gain on disposal or loss on disposal, but we don't bring the sales proceed together with the sales of normal stock. So number 2 is sales return or return inwards. So when we sell stock to customers, and the customers return those goods to our business. So that is what we call return inwards. They should be excluded. So when goods are returned by the buyer for some reason, it is called sales return or returns inwards. In the books of account returns, so return inwards account or sales return account, it is it is debited and the buyer's account is credited. It appears on the debit side of the trial balance, and we can show the sales returns in the trading account in 2 ways. It may be shown by way of deduction from sales in the trading account. An alternative way to show the sales returns in the debit side of the trading account. Then you also have the abnormal loss. Abnormal loss, this refers to the abnormal loss of stock due to fire, theft, or accident. If any abnormal loss is there, it is credited fully to the trading account because the trading account is prepared under normal conditions of the business. It has no place for abnormal instances. The other one is the closing stock. Remember, when we want to compute the cost of sales, you see that we start with opening stock, we add purchases, we add return inwards, we add carriage inwards, and we less closing stock. Why are we lessing closing stock? Because closing stock is not sold. It is still in our business premises. So when we are determining the cost of sales, closing stock remain unsold, and therefore we don't we deduct it when determining the cost of sales. So closing stock refers to the value of goods lying unsold at the end of any accounting year, and this stock at the end is called the closing stock. It is valued at their cost or market price, whichever is lower. The trial balance generally does not include the closing stock. The trial balance generally does not include the closing stock. Therefore, the following entry is to be incorporated the effect of closing stock in the income statement. So what you are saying, in most cases, the closing stock is not included in the trial balance. Reason, the valuation of closing stock as covered under IAS number 2, stock is valued at lower of net realizable value or cost. The lower of net realizable value or cost. So we determine the value of closing stock after the year end. We determine the value of closing stock after the year end, and therefore that is the reason. That is one of the reasons why the stock is not included. The closing stock is not included in the trial balance. It is determined after the year end, and therefore, in most cases, we find it in the additional information. We find it in the additional information and not on the trial balance. So we debit the closing stock, we credit the income statement. However, if the closing stock forms part of the trial balance, it will not be transferred to the income statement, but taken only to the statement of financial position. In case of the goods that have been dispatched to the customers on approval basis, such goods should be included in the value of closing stock. So these goods that are dispatched to customers on approval basis, it simply means that you said some stock to customers, you said some goods to your customers so that they can accept or maybe reject. So in terms of the sale of the law of sale of goods, delivery or the title or the ownership of goods still remain with the seller. The ownership has not passed yet to the buyer, and therefore the buyer may accept the goods or may reject the goods and return them back. That is what we refer as sale. That is a return, sales return or approval, sales approval. So you are sending goods to customers. Maybe you can send a sample of some goods to customers so that they can give a feedback whether those goods are one of what they would like to buy. When they approve, they buy or they give an order, then they also have an option to return them. So the sale of goods is not yet complete. So we have ascertaining the gross profit. Ascertaining the gross profit. After recording the above items in the respective sides of the income statement, the balance is calculated to ascertain the gross profit or gross loss. If the total of the credit side is more than that of the debit side, the excess represent the gross profit. Conversely, if the total of the debit side is more than that of the credit side, the excess represent the loss. So trading account, the horizontal format. So on the debit side is where we are finding the opening stock. Purchases, we add carriage inwards, we less return outwards. Cost of stock available for sale, we less the closing stock to get the cost of goods or the cost of sales. Then we get the on the other credit side, on the other side of the credit, we have the sales. We less return inwards to get the net sales. Then the net sales, we less the cost of sales to get the gross profit. Or gross loss. So if the balance is on the debit side, it is referred to as the gross profit. But in the event that the balance is on the credit side, it would be taken to be a gross loss. So the vertical format, and nowadays this is what we are using. The vertical format of the trading account. You have the sales, you less return inwards to get the net sales. Then you determine the cost of sales. Remember, cost of sales, you have the opening stock. We add purchases, we add carriage inwards, we less return outwards. Then you get the cost of stock available for sale. You less the closing stock to get the total cost of sales. Then the total cost of sales, you deduct it from the net sales to determine the gross profit. So we have a small illustration. So from the following details, you are required to draw up the trading account of Mr. Karaja for the year ended 31st December 2010, which was his first year of business. So you have the details: the carriage inwards, return outwards, return inwards, sales, purchases, and the stock of goods. Stock of goods as at 31st December 2010. So stock of goods as at 31st December 2010, that is simply the closing stock, So to prepare the income statement, we are taking the sales, you less return inwards, to get the figure that remains after deducting the return inwards. That is what we call the net sales. Net sales, we less the cost of sales. So cost of sales, we have the opening stock. In this case, remember, this is the first year of Mr. Karaja's business. So Mr. Karaja just opened the business this year, and therefore we don't start with the opening stock, because opening stock means last year you had the closing stock. In this year, it should be taken to be the opening stock. But now, Mr. Karaja just started the business this year, and therefore we are starting with the purchases. We are not starting with the opening stock because this is the first year of business. We are starting with the purchases. So purchases, we add carriage inwards, we less return outwards, we less the closing stock to get the cost of sales. So from the net sales of 757,040, we less the cost of sales of 520,380 to get the gross profit of 236,660. So you can confirm that our total cost of sales is 520,380, and our net sales is 757,040, and the balance that we get is the gross profit. If that balance was a negative, then it would be a gross loss. So we still have another illustration. The following details for the year ended at 1st March 2010 are available. Draw up the trading account of B. Osongo for that year. So we have the year is ending that 1st March 2010. And when the year is ending that 1st March 2010, it is starting on 1st April 2010. So when you find that we have a stock on 1st April 2009, that is the opening stock. Of this year that is ending, that 1st March 2010. So opening stock is 16,523. Shillings is in thousands. Return inwards. We also have, so return inwards, remember we have said that we sold goods to customers, but our customers returned goods to our business, and therefore you're supposed to deduct it from our sales. Return outwards, it simply means that we made purchases. After we made purchases, we returned some goods back to the supplier, and that is what we are calling the return outwards, and it should be deducted from our purchases. So then we have purchases, we have carriage inwards. Remember, carriage inwards, we said that this is, in simple terms, it is the transportation cost. The cost that you incur to get your goods from the supplier into your business premises. That is what we call carriage inwards. It is added together with the purchases when you are determining the cost of sales. Then you also have sales, and you have the closing stock. So to prepare our income statement, we take sales, you less return inwards, of 1372 to get net sales of 93,228. I hope you are confirming using your calculator. So 94,600 minus 1372, you get the net sales of 93,228. Then we determine the cost of sales. starting from the opening stock. Remember, on the trial balance, we have the opening stock. Stock as at 1st April 2009 is 16,523. So that is what we are taking as opening stock. We add purchases, we add carriage inwards, we less return outwards, because we have said that we purchased the goods and then we returned them back to the supplier, and therefore you have to deduct them from our purchases. Then finally, we less the closing stock, because we are lessing the closing stock because it is still in our stock and therefore it has not yet been sold. It is not yet sold. We deduct it from the cost of sales. So what you get now is the total cost of sales. Total cost of sales is 18. That is total cost of sales is 49,642. 49,642. We deduct it from the net sales of 93,228, and what we get is the gross profit. What we get is the gross profit. What we get is the gross profit. So we are going to close our class at that point, and then we shall continue with determination of net profit in our next lesson. So we shall continue with the determination of net profit or loss in our next lesson.